of your 24 hours today, if not of the month, to be. We have a really good set of speakers joining us today, and a super conversation on how to mobilize local capital. But we're going to give it a few minutes, probably till 6:05 before we get started. In the meantime, feel free to introduce yourself in the chat, probably mention where you're signing in from for today. And Steve, welcome.
Thank you very much. Good
Welcome, Steve.
afternoon. Hello.
I was asking everybody else if they know you, and they're like, who doesn't know Steve in this continent?
Who don't know all these two others?
Exactly.
All these three others, actually.
I was telling them that Steve is my ogre. He's one of my investors. So we cannot proceed without him.
No. Thank you so much for joining. Steve, are you in Ghana also, like I'm Dia, or are you dialing in from somewhere else?
I'm gallivanting.
Oh,
I'm
wow.
currently in the US. I'm currently in the US, in Maryland.
Yeah. Okay. How is it in the US now? It must be quite hot.
Yeah, it's I like that weather. I'm okay with that.
Okay.
Yeah.
I can tell you, in Nairobi, we have our winter. So when people say the summer break, I'm always like, not summer break, winter break on this side.
Yeah.
It's been clocking 12, 13 degrees, which for here it's quite cold.
Really, yeah.
Okay. I think it's 6:05. We like respecting time, and I think some people will join us in the course of the AngelConnect session. So what I like to do is to quickly invite Fiona just to usher us in, and then we'll just jump straight to the conversation. We don't want to keep, we do want to keep it strictly an hour and make sure that we start and finish on time. Fiona?
Hi, everyone. Thank you for joining us today. I think this marks a very significant part of AAA, as one of the key things that we aim to do is to ensure that the entire early stage investment ecosystem is not only knowledgeable and in the know of what is happening in the ecosystem, but also is able to receive structured learning. So if you're new to the community and joining us for the first time ever, allow me to create some context with regards to who the Academy, the African Angel Academy is, and the why of AngelConnect. So the African Angel Academy is a platform that provides structured learning, mentorship, and skill sets to early stage investors across the ecosystem, both locally in Africa and in the diaspora, through training and also through support and through investment facilitation and guidance to ensure that they're investing confidently and not blindly. Over the past 5 years, this is our 6th year. We're celebrating AAA at 6. Over the past 5 years, we've managed to train over 900 angel investors across the African continent and the diaspora, with 33 African markets in Africa and 5 global markets, including the UK, the US, and Germany. So if you're out there and you're looking to understand the fundamental mechanics and structured pathways into angel investing, AAA is the way to go. We do ensure that with the programs and support that we do provide early stage investors, that we do encourage participation of female and women in the ecosystem, and we're really excited to share that 5 years on, our cohorts and engagements and alumni community currently stand at 55% in terms of female and women participation. AngelConnect is one of the avenues through which we ensure that adequate thought leadership is provided on themes, focus areas, and happenings across the early stage investment ecosystem, like the hot topic for today, which is understanding how can Africa really mobilize more local capital and therefore ending up to own more of Africa's wealth and supporting its innovation structures. Really excited to have the panel today, moderated by our very own Stephen Gugu. And you're welcome, and really excited to see the turnout. We'll engage later.
Thank you, Fiona, for the warm welcome. And I'm super excited about today's conversation because, as I was saying earlier, I think the speakers we've put together for these AngelConnect are probably, I think they're the people we need to be having at this point talking about the challenge that you're facing in the ecosystem. So without much further ado, allow me to I'll do a quick intro of the speakers and jump straight to the questions. But feel free, of course, to add anything else from an introduction perspective. So we have 3 power speakers. The first is Hamdia Ismaila. And Hamdia is the CEO the founder and CEO of Savannah Impact Advisory. And she'll speak more about what they do at Savannah Impact Advisory. But I think why we wanted to have Hamdia in this conversation is because when you're speaking about early stage investing, one of the key questions that comes up is what are the systems, what are the policies that need to be put into place to create confidence, to ensure that capital is able to flow from early stage investors, from pensions, from corporates in this case, to be able to move into early stage ventures. And Hamdia has been playing a huge role in terms of that question around the systems. We also have Ibrahim Sanya from Silverback Holding. I have to say that Ibrahim, probably 3 years, 4 years ago, I had not heard about you. And it's like, I think you took the African investing ecosystem by storm. And now I see you everywhere. It's like, once you see Ibrahim, you see him everywhere. And you read a lot about him and the kind of work that he's doing. But the reason why we thought it would be exciting to have Ibrahim is because he's been involved in the investment ecosystem, right from investment banking to working with some of the development finance institutions in the continent. And he's big in terms of mobilizing large pools of African and institutional capital and deploying that capital. And so one of the key questions we want to spend asking is where is the capital? Why isn't the capital flowing as fast as we want it to flow? Because on one side, we have early stage investors who are looking for capital and they're finding it challenging to access this capital. We have institutional pools of capital, which seem to be locked within the different institutions, maybe because of policy and so forth. So we want to discuss about that. And then we have Sewu Steve from Sewu Steve is a friend. I've known him for a number of years. He does a number of things. Part of them is, a number of them focus around in deploying early stage capital in the continent. He's an angel investor. He's a fund manager and Jazza Rift Ventures. He does a fund advisory if you want to set up a fund, if you want to think about the tools you need to create, the structures you need to put into place to be able to put together a fund. He's one of those people that you can speak to in this case. But on top of that, he used to be a member of our Angel Network and has made several investments, and is also the director at the Accra Angels Network. So, as I mentioned, for me, this is a really super panel to be able to answer the question. And the question for today is just mobilizing local capital, how early stage investors are closing on Africa's funding gap. So, gentlemen and lady, first of all, have I done justice to your introduction? I'm sure you probably want to paint a bit of color before we jump onto the question. Hamdia, I'm going to start with you and then jump to Ibrahim and then move to Sewu Steve. Hamdia?
Thank you, Stephen, and a very good afternoon from Accra. I think you introduced me the way that you should, based on what you wanted me to talk about, but I'm also an angel investor. And I just have a firm belief that we need to put our money where our mouth is. So there should be a lot more, doing more from the African perspective, bringing in more local capital to support early stage companies. And I just believe in that. And I haven't wavered in that because I think that is the way to go. So it's a pleasure to be here.
Thank you, Amdia. Ibrahim? You're on mute, Ibrahim.
A pleasure to be here. I think your introduction was fabulous. Don't think I can do better. I think just like my sister, the continent is the geography we are passionate about. And my entire career has been dedicated to the continent. So I am unapologetically biased towards our continent.
And we need a lot of that. Thank you, Ibrahim. And I have to say, you guys are quite humble. But let me hear from Steve. Steve, anything you want to add on your intro before we jump in?
Thank you. You've said it all. What I would say is that we had an interaction recently on China AI, and I think I want to plug in the AI component, which is critical today. So I'm also into doing AI systems on the continent as well. But that was very, very on point. Thank you. I'm really happy to be here with all my brothers and sisters.
Indeed. Okay, thank you very much. So let me lay a bit of context just to get us started on the conversation, because I want this to be a conversation. But of course, if you're listening in and you want to ask any questions, feel free to do that in the chat and we'll pick those up. But just to get started, we're in this space where someone who's joining the Africa early stage investment ecosystem, or someone who's probably lived through this ecosystem maybe for the last 5-10 years, they've probably seen only one side of the ecosystem, and now they're really worried because of what's happening. On the one side, there's a messaging we are hearing that it's a time for Africa. As Africans, we need to own our destiny. We need to unlock the pools of capital. We need to make investments to, resolve some of the challenges, some of the opportunities we have the continent. That's one clear message. And so for someone who walks in, they hear that message very clearly. On the other side, when you look at the hard facts and ask yourself how we are doing from a funding perspective, from the highs of 2021, 2022, funding has been going down. I was just looking at the half one 2026 investments in the to the early stage investment ecosystem in the continent. The total funding was around 1.36 billion, which was 6% down from 1.44 billion last year. Equity funding is down about 7%, and the debt funding has been flat. The total number of ventures raising at least $100,000, and I'm quoting figures from Africa the Big Deal, were 190, and this is the lowest half one numbers since 2021, right? And then there's also the other fact that we've also had a number of casualties. Of course, this is venture capital, but we've had a number of casualties. I know certainly that part of my portfolio has gone through that as an angel investor. And so I guess for someone joining in, one of the questions they're asking themselves is that, how do I reconcile everything I'm hearing? Where are we in terms of, from an ecosystem perspective? If you look at, and Ibrahim, I'm going to point this question at you first. You've been investing across, from an institutional perspective, from an angel perspective, for a period of time. So when you look at this moment, how does someone make sense of it? Where are we in the ecosystem? Where are we in terms of the timing from an investment perspective? Where are we headed? How should someone think about, writing their fast check at this point? Ibrahim.
Well, I think my answer shouldn't be prescriptive, because I think it is biased by 30 years of watching the market. And what's important is that 20 years, 30 years ago, there was not an opportunity for someone to put their savings into an entrepreneur and get that entrepreneur to multiply your money by 100 or 50, right? So it's a relatively 10 to 15-year-old phenomenon. think before, if you have your savings, you're helping a family member who himself is driving that business. And I think technology is what has been different in the last 50 years, is that technology allows an acceleration that didn't exist before, at least in this side of the world. And equity itself historically has been a complex asset class for locals. That's why across all of our 54 countries, you have a series of laws that forces the pension funds to ascribe capital to private equity. But all of us here in the panel know that we do chat to different pension funds. We drink coffee, we drink tea, but very rarely something happens. So that's at the high level, which is private equity. So you can only imagine that to go into venture capital, which is a higher level of risk, that local money will be quite hesitant, because the biggest issue is that local capital, when it comes from pension funds, has a highway to gain. The highway to gain is a treasury bill. So all of us as humans, if you have the choice to not pay a toll to take the highway or take the long road, you know what you're going to do. So I think it's very difficult to be upset at them. They're only taking the shortcut, the highway. In fact, it's not even a highway, it's a private jet within the city, right? So why bother with taking someone that has a car that may crash and you may die? That's, I think, the fundamental challenge you have for local capital, and those are savings. So I think for that to change, you need to push performance. So those of us that are lucky need to take a microphone and talk about lucky accidents. And I think that's what we've been doing. So I think we've been luckier than most, but it's still luck, right? So I think the more local market hears about this trade of luck, the better, because it's not an African problem. Fundamentally, only 5% of these businesses survive. This is a highly mortal industry. So that's 95% of the companies you back are going to die. So your traditional SME that we know here in Africa, whether you're doing agribusiness or you're doing a pharmacy, has a much higher probability to be alive. So given the level of risk, you need to make sure that whenever it works, everybody knows about it. Because when you look at it, the ratio of failure are the same in the US or United States of America. It's just that we just oppressed by the news. We hear Google, Apple, and it sounds as if that's the only companies that exist. But there's like 2,000% failures that we never hear about. So I think that's one of the first jobs, is that the successes are not going to be pervasive, but when they happen, they need to be very visible so that people can see that that option makes sense. I think that's one of the biggest issues, return of capital. And until capital is returned, then it becomes an issue, irrespective of the time you is. All the points you made are right. We're currently in a slight correction, but there's slight correction everywhere. But by the time it comes back up, people need to know that if I decide to give money to Mustafa or Christian instead of Aliko, or instead of government of Ghana or government of Nigeria or government of South Africa, it has to work. So if all of us remain silent when we accidentally lucky, then for sure the entrepreneurs will not get the money.
Ibrahim, I want to do a quick follow-up to your answer. And I like the humility of saying, we've been accidentally lucky. That's quite humble. But what plays into the luck, because, you've had a couple of exits, and feel free to mention, a number of them. What do you think has played into that lack that someone could pick and say, you know what, what are the lessons to pick from those so that we can increase the number of, accidents?
So I think for us, the what has created frequency of luck is working in partnership with other fund managers. So we work with other fund managers like syndicate, right? So we just have taken the syndicate model to private equity, right? So the syndicate spends a lot of time. Think about it as a reverse pyramid, right? Syndicate try to get you to reach wide. And then as you spend time with the syndicate, you make a cluster of friend of angels, people you like to do deals with. And then ultimately you guys do a smaller subset of those deals. So I would argue that all we're doing is syndicate work, but at the private equity level. So I think our only secret sauce is that we backing fund managers, and then we work with them to figure out what are the companies that fit our filter test. And our filter test is 5 items. So we just spend time perusing their portfolio. And as companies fit those criteria, then we just do more diligence. But that, I think the key point there is people that know what they're doing, and that's not us. Us, we're basically someone that comes to the mall, but you need to go to the right mall. But at least we're clear about our criteria. So I think once you're clear about your criteria, the product market fit is that model working? Because if that model works, then you just repeat. You just kind of stay selective about who fits that bill. So I think that's been the only thing that we've done right. And now our formula of selection was linked to what we view to be the 3 problems of African private investment. So those 3 problems for us are local currency, volatility, provided you get the money in foreign currency. So for us, that's the first technical misalignment. So if ever we're getting our money in Ghana money, in Nigeria money, in South Africa money, then we will not care about that problem. But because all the money the sector gets in VC is usually dollar, in private equity is dollar, then you basically back an entrepreneur that fulfill his metrics in revenue, his metric in EBITDA, and then something happens with the SEDI or the Naira or the Rand, and he's down in performance or misses the. So for us, we had to find a way to avoid that. So that's why one of our biggest selection criteria is export revenue, export related revenue. So that's why I was saying that it cannot be prescriptive. For us, that was a primary selection tool, and there's not many tech companies that are necessarily export oriented. But I think we wouldn't be lucky if there was not a set of fund managers almost like a syndicate. Because basically we are all over 45 years old, and VC is new to us. And, it's really a young person craft when you think about it. So relying on the fund managers is very, very important. So I think any angel who's new to this, to answer your first question, I would argue, don't try to do it by yourself. Do it with a syndicate, do it with an advisor like my sister, work with my investor here, still people that have been there, because it's only through the exchange of discourse, knowledge, and data that you will define a taste.
Yeah. And Ibrahim, you mentioned 3 things, but I think you didn't share with us. You mentioned you have 5 filters that you use for the funds you're working with. Then you mentioned these 3 key problems. And you mentioned one of them was, if you don't mind just walking through those 2 elements.
Sure, those were the biggest point. So the three things, the first one is currency volatility. The second one is blind pool. And the third one is commingled deals. So the last 2 points are really the traditional structure of a fund or private equity vehicle. It's commingled and it's blind. So as an investor, you don't know what the fund is going to do. You're basically blind. You just have to trust that the manager can do it. The other problem is commingle. So commingle is the same as exposing yourself to a viral infection, right? So if it goes well, then great. But if it doesn't go well, the bad deal can really sever your fund. So for us, because of those three issues, our entire execution is linked on those three issues. But because of those three issues, so if we were a founder and we were speaking to a pitch, we'd say these are the three problems we're trying to solve, and what we're executing is what we're executing to solve that problem. So we tend to avoid large exposure in businesses that don't export and that don't do 30% of their revenue offshore. So that's why it's one of the filter. But the second is that we will look for a company that has more than 2 to 3 years of history and data and is still growing over 60%. And that means that it's not an early stage. So it means that it must have been in the hands of a fund manager or has gone past seed. It's going between seed and Series A or Series B. So you can look at the data. And then the third one is effectively that the company is able to provide what we call a jaw-dropping customer experience, which is that when the experience the client is experimenting is so rich that he decides to move from your P&L to your cap table. So if you look at all of our top 10 positions, they're companies that already have a former client in their cap table. So Move, which announced today their $250 million raise, has Uber on their cap table. Uber started as their customer. They have Toyota. Toyota just joined the cap table. It was just announced today. And then one of their biggest clients is Waymo. So if you're able to start a product solving a problem and the customer says, I'm going to give you revenue, but then decides to self-identify. So it's really the passage from liking your product to self-identifying to what you do. And that manifestation is coming to your cap table. So that is the biggest signal for us to do more, because basically it's not even anymore a boring banker like us or an investment person trying to make a judgment. This is actually the sector saying this business is so important that I want to be in the cap table. So for us, it's an obvious signal that this entrepreneur is damn good, because basically the industry has vouched for them. But that's also important because that's a path to exit. And as we were saying in the beginning, the biggest challenge here is exits. So for us, it's literally the industry coming to tell us this thing is exitable. It's not Ibrahim, it's not Nana, it's not Nima, it's not a member of the team. It's actually the industry has spoken. So for us, it just gets us to decide to put a lot more money. And then the fourth is basically that the board of the company has expressed that they want to do more business overseas. And that comes on top of the first one I listed, which is having 30% of the revenue offshore. But that last point of expressing it from the founder and the board is crucial for longevity, because we've studied that the businesses in the whole of Africa, 54 or 55 countries deciding on which side you are. In all those countries, 1.5 billion population, there's only 16 companies that make $1 billion US. 16. So that's not a fantastic stat. That's pretty sobering. So the common tissue with all those 16 companies is that they export something. That's Capitec in South Africa. That's Rand Merchant Bank I'll keep on listing a lot of banks, and people don't think about a bank as an exporter, but moving money is exporting. That's MTN. You don't think about MTN as an exporter, but you're moving voice conversation and data. That's exporting again. That's obviously Sonangol. That's obviously a lot of the mining companies you have in South Africa and North Africa. But that's also Ethiopian Airlines. So when you think about Ethiopian Airlines, you don't think about exporting. But when you enter a plane, you are being exported as a person. And the bill you pay is also in foreign currency, right? Yeah. So fundamentally, the numbers gave us the answer. We're like, you know what? We cannot decide to be subjectively smart, but if you look at the history of Africa, all the companies, and it's very hard to make $1 billion of net profit, despite local currency issues, despite change of management, despite local regulation and government change. Yeah. So that's like 12 months. You still have 12, not to mention that sometimes the management may be stealing some of the money or doing any funny business. So that's what they've decided to leave on the table. Because every dividend you leave means you're going to be taxed on it. So you can be sure that any company in Africa that shows you $1 billion in net income is probably racking a lot more, because a lot of them want to avoid paying tax. So when you realize that the enduring criteria is export prior to technology, then it tells you something about what works in this market. So for us, it's just being obsessed around that feature alongside the other 4 I gave you. So I think that's helped in the luck. But it's not because we're good hunters. We let the fund managers do the hunting. We're more like a farmer. So we're kind of farming for those five criteria. So you have to be patient.
Okay. Wow, Ibrahim, I had a number of other follow-ups, but it is a panel conversation. So let me jump in and bring in Hamdia to this part of the conversation. And Hamdia, I don't know whether you want to comment about anything that Ibrahim has mentioned, especially in terms of the moment we are all in. But the question I wanted to bring you in is that, Hamdia, you've been able to mobilize institutional or pools of capital to be able to invest in the early stage investment ecosystem through Chigaba. And I don't know, I just want you to maybe paint a picture of what does it take to create confidence to allow capital to flow. Because I think, in most of the African ecosystems, angels they're playing their role, right? But we're not seeing the follow-up capital that's required to make this asset class what it should be, right? We do need a bit of support for the angels to be able to make more deals. In this case, we need to unlock more pools of capital. So I just want you to talk to us about that and your experience in terms of that element of creating confidence so that money can be able to flow.
Thank you, Stephen, and thank you, Ibrahim, because you've really given us the foundation. And I think that is really where, when we begin to talk about local capital, we have to start. Because Africa is not shy of banks, because we have had a lot of banks doing what they have to do. And really building wealth took some time to start coming along. And that is where angel investing begins to come. When people build wealth, then they are able to spare some of their monies to do other things. Or when they make more money from what they love to do, they bring it in on board to also help others to achieve that. So I think over time, there's a shift where we are beginning to build more institutional wealth, right? And in building this institutional wealth, there is the need to begin to see what can we do to make it more. And what we've seen, and as Ibrahim said, I always tell people I have never put money in treasury bills, and people don't believe me. But in Africa, that's what everybody does, right? Mm-hmm. I mean, I tell people that I don't blame people who put money in treasury bills. I mean, at some point in Ghana, our government was paying 35% on treasury bills. So even the banks were putting their money in government, in treasury bills, so they can sleep and know that, you have 35%, right? So if you give 35%, why should somebody do something else? Right, and that's really where our challenge was, and now it's changing. Right, a lot of wealth is coming in. Although government is still borrowing, government is also beginning to be a little bit smarter and borrow a bit cheaper. So you have money in your hands and you need to do other things. What we saw in the market was that as we begin to build the wealth, and a lot of our experience in Africa has been banking. Then, remember that banking started first before capital market came, right? And so a lot of the asset managers you see in this continent are actually former bankers, unless a few who had worked in investment banking outside of the continent. And so capital market came after banking. And then now we are having private capital. And so there is a lot of skill gap in really doing private capital. And so when institutional capital started building up, all what we were seeing in the market is that it's either treasury bills, it's either government, other government securities buying government bonds and buying real estate, which we think that is what private capital means, and all of that. And we felt, how do we harness some of this capital to really build early stage companies? Really build companies for the future, because that's really the future. And we realized that regulation has not allowed. Most regulations is really constricting money still to sit in government, because government likes to control. And a lot of institutional capital also feel that it is safer to continue to do that, which then meant that we need to work a lot more in breaking barriers around regulations to allow the flow to happen. And so we need to work on that. South Africa has Regulation 28. That has helped a lot. And Kenya is still there, like Ghana and Nigeria. I think Nigeria is being a little more bullish right now. Ghana is also bullish. But we needed to get that regulation to allow that to happen, because it wasn't happening. Then when the regulation started tilting down to allow, then we realized that we actually have another gap, which is the skills gap. So Ibrahim talked about working with, fund managers, but these are not ordinary fund managers. These are people who can sit and look at a deal and can foresee how it's going to turn into. It's not everybody who has that skill. We underestimate that skill. It's not everybody who has that skill. There's a lot of skills to do that, and we don't have a lot of that, unfortunately. So then we needed to see, how do we then build around what we have that can do this, because there's also a proving to do, because you have a continent where, like I said, we are not shy of banks, so we understand banking, we understand credit, we know how to borrow money, and but how do we finance the real sector? How do we finance early stage companies? It's been something that we haven't learned to do and to do well. So how do we learn to do that and to do well and improve? And because we don't know how to do a lot of that, and that fear in our mind, we always propagate it with the fear. Oh, money isn't going to come back. These businesses are not going to work. It takes forever for money to come. So one thing that needs to be done is that money has to show, which is what Ibrahim and his team and others are trying to do, that money can actually come back when you do this type of investment, which is one proven point. So getting the regulation to work to allow it's been a good journey. It's happening by now. The skills to actually unlock that capital to invest properly, to bring the money back and prove that this is possible. That's where we are now. And we are doing it in ways that allows us. So for Chigaba, it's a fund of funds. So I think I do a little bit more like what Ibrahim does. I work with fund managers, but I work with fund managers that can prove that they have, they have the eye to see a company that they can believe that in the next 6-7 years can bring out something good, so that when money begins to return, that phobia that when money goes to the real sector doesn't come back, so let's give it to government because at least we know that it is risk-free. We will begin to see that, you know, we are actually not living in reality. And that is where we are right now, building the skills, working with the managers who are already doing it so that we can do more and bring more into the fold and be able to do more and unlock. And I think one thing that I also wanted to say, which Ibrahim touched on, is the fact that you cannot underestimate the potential of local currency. A lot of the things we hear, we read about non-performance of private capital in Africa is because of currency. And I'll give you an example, very close, not too far. I mean, in 2016, I invested in a fund in Ghana where the cedi to the dollar was 1 to 4. The fund manager returned capital in 2024, and the cedi to dollar was 1 to 16. The fund manager potentially worked for the currency. So these are real issues, and that is why, for some of us, we think that there is no other way if we want to build, because that's where we can show the true value of the work that we are doing with early stage companies, so that we can get the value out there. Because if all the money comes from outside, it is good because that's what has sustained us. But that shouldn't be the future, because these stories would continue if we do not do this, right? And Ibrahim did mention that you need to look at, in supporting companies, sometimes it's so painful. It's not that you don't like this company. You like this company, you believe in the potential, but you have an investor to report to. So at least you need to think around how to manage the currency risk. So you say, 30% has to be export, because you know that will come in as hard currency. You are not being mean. It's just living in the world that we are right now. So assuming that all this capital is coming from local sources, I tell you, Ibrahim will do more than what he's doing now. So that is why I feel that we need to continue to do that. It's not easy because the fear is been there for a long time. And like I said, like I look at Ghana, the Bank of Ghana is 70 years old. The country Ghana is 68 years old. So and our capital market is 30 years old. The Ghana Stock Exchange is 30 years old, right? And we are not talking about private capital. So we started it backwards. And so we need to build faster to be able to catch up. And I think that is where we are right now.
As you're speaking, a few things sort of come to mind before I bring in Sewu Steve, and it seems it's going to be one of those panels with one question only per speaker because of the depth that each of the speakers have. But there's this thought that when people are getting into angel investing, there's this idea that people imagine that I've done capital market investing, I've done real estate investing, I can get into angel investing. And I like what Hamdia you're mentioning, and I think also Ibrahim, you touched on this, just the kind of skill set you need to be able to look at a company and look at all the different factors, all these risk factors you're speaking about, from currency to whether they're going to raise the next round, to the customer, to the market, to the regulation and everything, and decide, okay, this is a good company I should invest in, and this is the kind of support they need to be able to move forward. There's a skill set, and if you imagine this from a perspective that as fund managers or fund of funds, you get going to that level of detail to sort of really understand the fund manager and what the skill set is, one. And then you're also going to another level, which is to understand sort of there's no gambling here, right? There's an element of understanding how do investments actually work? How do you create a unicorn? How do you create a company that scales, in this case, across market? And I like the pointers you're giving, Ibrahim, in terms of how many companies generate $1 billion in net income, right? And those are statistics that I think, and I don't mean that specific statistic, but I think as an angel investor, you should have some key anchors that tell you that this is a sector to invest in. this is the type of entrepreneur to invest in, because there's some data out there that if you spend time to look for it, you will be able to appreciate or make better decisions and be part of the 5% out of the 95% that end up failing in this case. So I'm just saying that, as an angel, there's one thing to pick from this, that skills, building your skills is very important. And then just studying history, studying, the different economies to find out what actually works is very important. Anyway, I'm not a panelist, but I thought just to say that. So, Steve, I'm going to bring you in.
But Stephen, I just want to say that is what Ibrahim said, and I agree with him 100%, that when you are now starting, don't start alone. Join a syndicate, because you will learn what not to do.
Yeah.
If nothing at all. And they will bring that their experience to bear. Also, it allows you not to lose all the money, right? One advice I give to people is that for your first angel investment check, sign a check that you will not cry when you lose it. So
okay.
So those are the keys. That's my addition to what Ibrahim said. Syndicate, sign a check that you will not cry when you lose it.
Yeah.
Syndicate, else your wife or your husband will leave you, losing the money.
Steve, let me bring you in. Yeah. Steve, you've been writing, early stage checks as yourself from a fund perspective, and I want to go back to the initial. Yes, way too many, which is good, because then and you didn't start angel investing yesterday, right? You've been doing this for. I mean, you tell us for how long you've been doing this. But I want you just, I guess, for an angel who's getting started, I want just to ask you, how should they be thinking about this moment? How are you thinking about this moment when you're writing a check to the next startup?
Yeah. Wow. When you asked the question earlier, I thought to myself, that's a tough question, because it also depends where the angel is coming from. So I'll tell you a very short story on how I started angel investing. So I used to be a trader, equity, fixed income, derivatives trader, right? Stock market, like 6 to 8 screen, doing stuff, I was tired of numbers. I said, look, I want to be closer to the real life of companies, etc. And I had a dinner with my cousin in London, and there was a lady sitting next to me. And essentially, she was looking for money to set up a business in London, a Ghanaian lady. And essentially, it was called Top Pot. And the idea was to create takeaway food for Africans in London. So imagine you have a jollof rice in a pot. You went all the way that it was well packaged. It ended up in Sainsbury's, the Tesco's. It even had like a McDonald's Top Pot out of London, Liverpool Street in London. And then another one in O2 Center. So to build a business that was starting just like that, all the way to being a retail store, we had two. But during those, 8 years of holding, I invested £10,000 then. Look, you do not see the amount of hours I spent on Skype traveling to see her. So initially she was cooking in her apartment. Guess what? The apartment burnt. Luckily she had insurance, right? Oh. Right? So as an angel investor, my first deal was even a £10,000 loan. Look, I went like this so many times. Ultimately, I got the money back. I was so happy just to get the money back. £10,000, 8 years after, inflation adjusted everything. I was so happy.
That did happen, yeah.
Right? But you know what happened? I got hooked. And that's how I started my angel investor journey. Oops, he dropped off. It's fine.
He will be back.
Yeah. And so, to tell you that, and retail, food business have always been something I was personally interested in, but I don't have any experience in. It's just that I really believed in the founder. I really believed in the idea, because look, that was 2003 Top Pot, like doing Ghanaian African food in London as a retail. So it's quite innovative then. And so fast forward today, I would say that if you're an angel investor today, just like my other two panelists said it, look, do not do it alone. Also add exactly the same. Train yourself, get training formally. It's better. I learned on the job, as you can see, as I told you about the story. But also what I feel also helps a lot is your first investment, obviously, you can lose the money, all it, so it shouldn't be so critical as Hamdi and Ibrahim said. But also do it in a sector that you have deep understanding in. That's the mistake I made, right? Because I mean, I like food business, but I didn't have any expertise whatsoever in food business, right? And so what I would say is that try and make your first investment in a sector you have fairly deep understanding. So you really have a value add to the entrepreneur, but also give you a lot more trust, de-risk it in your mind, right? And so that's the other thing I would say. An additional point today, and I mentioned it earlier, I strongly believe that to some extent, there has to be a level of AI, not AI washing, please, and we can discuss that for a long time. But there has to be a level of first automation, and that's what we do also, but also AI or bot or some sort of automation in your process because it's going to happen, it's happening. If you miss that boat in your business model, you'll be eaten up very quickly by others, right? Especially when we're talking venture capital, right? Even the terminology, sometimes we have problems with it in various places on the continent, right? So venture is really tech-driven investment. If you're doing anything else, it's more small cap private equity or just investment. It's not venture capital because you expect 100,000, 200,000 return. It's not 3 times money or 4 times money, which is private equity. And so that has to be very, very clearly defined. Yeah. So yeah, to your question, really one, invest in something that you understand because you come from the sector. Is it marketing? Is it communication? Is it agri? Is it finance? Is it climate? Whatever it is, try and invest in something you understand. Don't invest alone. Syndicate and train yourself. These are the fundamentals. I think maybe a few other points I would add is after what more than 30 investments with my own capital as an angel, what I realized is that for me, beyond all the criteria I've seen and we've discussed now, the one thing that consistently came by where I failed, and even as an institutional investor, actually I failed also, is not to invest in coachable entrepreneurs. Coachability of an entrepreneur is a fundamental. And I'm not saying somebody that says yes to everything you say, but somebody who's ready to listen and implement what the person thinks is aligned to her vision or his vision. Okay. Coachability, exchange, look, a two-way street. Because for me, and I made the mistake again recently, and it's not because you made the mistake once that you can avoid it all the time, right? You may be, I'm enamored with the business, etc., and make the mistake again. So you always have to check yourself where I invested in an entrepreneur, think, oh, there's a bigger investor who has written a way bigger check than me, right? I had written just $50K. And there was this, institutional investor that wrote 3.5 million into the company for the same round, etc. So, yeah. So I was relying on that investor on a number of things. Big mistake because for that particular entrepreneur, I already had my red flags. I said, oh, no, maybe I'm too negative, etc. Let me just rely on the bigger investor. Do not make that mistake. So once you kind of develop your own thesis and experience, coachability, and for this particular one, he was not. Actually, he was even full of himself because he had this big investor. So my 50K, he even told me, and I was shocked, that, oh, I only invested 50K. So he doesn't even want to share additional information with me. It's like, are you mad? Anyway. Steve,
Wow.
Let me let you finish the point.
Yeah. So the funny thing is, unfortunately, his business closed down. And I realized that a lot of the things that I had seen at the early stages could have been solved earlier because the bigger investor wasn't involved in the business. Whereas me as an angel, I'm much more involved, right? I can help you do commercial development, review the model, poke holes in the thing. But I think, as I said, coachability of an entrepreneur is a critical one for me.
Wow. One lesson I'm picking from this for the Africa Angel Academy is we should not have such power speakers all in one session and assume we're gonna cover everything in an hour's time, because I feel like we've barely scratched the surface and the hour is out already. So I'm gonna be forced to ask one closing question, and that's not because I didn't have another 20 to ask. And we'll invite each of you probably for your own AngelConnect sessions by yourself. Uh, so the question I want to part with, and it's the same question for each of you, is just what's keeping you optimistic at this point around investing locally and investing in early stage opportunities, especially with everything we're hearing. On one side, there's the AI train that's coming. And you can say that, there's opportunities that are coming with that, but there's also a lot of disruption that's potentially coming with that. There's the fact that, if you look globally, there's been a lot of pullback from local markets. There's, if you look across the continent, across the world, there's a lot of chaos that's happening everywhere you look. There's a political issue here, there, etc. So I'm just wondering, for someone who's listening to this and just like, give me some optimism. What are you seeing that I am not seeing? What would that be for you? I'm going to start with you, Ibrahim, then Amdia, and then Steve.
Well, I'll start by first saying that Steve is francophone like me, so he's a very humble person. So whatever he said, please realize that he's giving you the filtered version. He's one of our investors, someone that does all the things. He did sports with us, and it's a situation we're invested in together. And I think one of the biggest points I retained from him is, I think, what also links to my optimism, because I think when you realize where we are at as a continent, and this new thing called technology that has aggregated, you can see from the members of the panel, we have very various experiences from traders, my sister, like we've really come from completely different horizon, and we made it around technology and venture and angel investing. But I think I like to remind people all the time that there is noise and clarity, and those two are different for a reason. There's been maybe in 2006, there was the world depression. Then there was like the COVID. Then right now there's a war in the entire Middle East. I mean, the only parts that are immune are actually literally, even Spain is getting dragged into the war from Morocco. Like nobody left Morocco, but people are saying we're invading Europe. So despite all this, we have to remember that the continent as a continent has stayed a primary point of dragging external parties to come and extract. Today is one of the rare points where there's like energy war, energy issues in Hormuz, but Dangote is the one feeding the world. When we had the COVID, people were telling us we're all gonna die. We're all here. Colonization came, tried to take over our land. For most of the part, we've kicked them out, and we're still here. Slavery came, took our grandparents, we're still here. So I think the continent, because of the mass, because of the density of entrepreneurship spirit that exists, is not going anywhere. The same speech you hear about AI today is the same that was happening when GSM was at the center of our careers. People were telling you, oh, the Americans are building fiber. We're so left behind. Today, Africa is the largest concentration of mobile money in the globe. We are the world champion. We're like the Pele of mobile banking in the world. Nobody knows it. But back then, people were saying, oh my God, these people, telephony is going to leave them behind. So you can be sure it's the same today. All this noise about AI, people taking the water of cities, taking the electricity of cities to do a super fast to Google. I'm not anti-AI, but if you look at how your life was 4 years ago and how dramatically, whether you're going to die if AI was no longer working on your computer, you'll be very fine. You will not collapse, you will not die. So you can be sure that in 5, 10 years, maybe we'll have some robot trying to take our life, but virus have not killed African, white man has not killed African, AI is not going to kill us.
Thank you, Ibrahim. I'm going to run straight to Hamdia.
Thank you. And thank you, Ibrahim. I think that we haven't scratched the surface in terms of the things we need to do in this continent. And that is why I think that opportunities abound. And so there is a lot more to do that we haven't even started. But one thing that I just want to leave the audience is that an African founder is not only looking for money, he's looking for distribution network, is looking for regulatory cover, is looking for you to open doors for them. And that is what a local angel investor can do, because you're on the ground. Your network can be leveraged to do so many other things to open the door for them. And this is where it is very, very important that we begin to assert ourselves to be able to do more and also to unlock more. And there are a couple of angel groups around. I mean, the AngelConnect is there. There are a lot of people you could connect with if you are a new angel coming into the fore, and make sure that you find the right network and learn a lot more. I see a lot more syndication now than before. And so there are so many things that you could do, but we haven't scratched the surface yet. So we are just about starting now. And so there is so much to do. And I think we should begin to work more towards that. Thank you.
Thank you, Hamdia. And Seu Steve.
Sorry. Yes. No, this really is a critical element. We're still there. We'll still be there around the corner in the next 10 years. What I would say is that for me, what gives me joy and hope is that slowly we are also, and I would say we as both as angel investors, but more and more our governments and the regulatory bodies realizing that we have so many assets we can leverage. And one key thing we should do on the continent, and really it's a call to action, we need to generate substantial power. And so if you can get anybody you know to be an entrepreneur in the energy space, right, or invest in the energy space, for me, it's going to be a game changer in the next 5 to 10 years if we can generate power, because that will solve a lot of the challenges we have today from data, from anyway, I can mention so many. So power is going to be critical because AI would be only leveraged if we have the power and the skills, etc., etc. But for me, power is the fundamental. Yeah, and there's hope, as I said. Yeah. You muted.
Wow. Yes, I was muted, but no longer muted. Gentlemen, thank you so much. I will keep my promise to host you for different AngelConnect separately, because I think we could have spent just time with each of you and fill the 60 minutes adequately. That's been extremely powerful. I think I'll finish with a few things that have been mentioned. I think the first thing was about this idea of skills. As an angel investor, or someone who's looking to make investments into the early stage investment ecosystem, make sure you get the skills, make sure you understand the context we are in, look at the companies that have been successful in other spaces and so forth. I think very important. I like the point around syndication. Don't do it alone. There's power in hunting in groups. So please join an angel group, join a syndicate, co-invest with others. You're going to get much further with that. And then there's a point around coachability. When you're looking for your founders, make sure that they're coachable at the very least. If that is not there, leave them. I think Steve has given us a lot around that. And of course, the positivity, the positive end to the conversation today, that we've faced much greater adversity and we are still here. So, we'll go through this one. We've barely scratched the surface. And of course, power is everything, is what's going to take us to the next level, because it's going to resolve a lot in this technology space. Thank you very much, panelists, for joining us for today's AngelConnect. Thank you very much for all the listeners who joined today. We really appreciate it. Let's show some appreciation to our speakers by using some of the emoticons that we have. I think it's been a very powerful session. I wish you a lovely evening and rest of the week. It's 7:08. We went over time, but for a good reason. Thank you very much.
Thank you. Thanks for the gift of your time, everyone.
Thank you. Bye.
Bye.